Welcome to the Techno Fundamental Report for January the 12th. Ecclesiastes 1:9. What has been will be again. What has been done will be done again. There is nothing new under the sun. This was written 3,000 years ago. This is Old Testament. And one thing about things not changing, in nature, there's a pattern. Look at these seashells. They all have a pattern in nature. The fern, you can see the repeating pattern. When it comes to human behavior, it repeats. It's been repeating for 3,000 years. So you don't want to underestimate the benefit of understanding human behavior when you're dealing with an auction market. Now, I want to remind you, this is the AAII survey, the American Association of Individual Investors. They do a weekly survey asking, are you positive, are you negative, are you bullish, or are you bearish? And so the way I've set up the graph here, the indicator, is we have a zero line, and when it's above the zero line, it means that people are more positive than negative, more buyers than sellers. Down here, you've got more pessimism or more bearishness, so more sellers than buyers. So, if you go back to like '09, you can see that we had an extensive amount of pessimism. People thought we were losing the banking system. This is COVID. People thought we were all going to die, Now, we are now going over 40 weeks below zero. So I believe that we're starting to see the sellers starting to dry up because things have just gotten too negative. In other words, the market discounts the future. So what the problem here is with human behavior is, I've been doing this going on 50 years. I find that people just refuse to think positively about their portfolio here, and they always want to put money into their portfolio up here, which is the exact opposite of what they should be doing. Now, I did want to note one other thing. I've got the VIX, the volatility index, down here. And one thing I have been concerned about is, are we going to get a spike in the VIX or a panic sell-off is basically what happened in '09. And the beauty of the panic sell-off was that was the bottom because, the panic sell-off came in early '09, and by March of '09, the market had made a bottom. So you can see here back on COVID, we also had a spike above 50 on the VIX and not as much of a panic sell-off. So we could get a capitulation in here. I don't know if it's going to happen, but one thing to note is it's a very rare event. It doesn't happen very often. So kind of back to understanding, right now, people ask me, why do you look at the new lows, not the new highs? Well, when you've got extreme pessimism out there and the market has dropped dramatically, it's going to take a long time to see new highs. Whereas when you've got sellers dominating the scene, you're going to start to see a lot of new lows. Well, as you can see here on the New York Stock Exchange, we have now, since the turn of the calendar, since the beginning of the year, we've had 6 days below 40. Now, usually I'd like to see 8 to 10, which we may see. But the point is, it's starting to look like the sellers are running out of steam. Now, if we go to the NASDAQ new lows, you can see the same scenario here. We're seeing a divergence of new lows in the NASDAQ. We're seeing fewer new lows. So it does somewhat appear that the sellers are drying up. Now, what we need to have happen now is the buyers come in. Now, when the buyers come in, this is going to be a choppy market. You have to be aware of that because when you've come off of a major bear market, you're going to have to grit your teeth a little bit because there's going to be volatility. So a choppy market. Now, I did want to mention the January barometer. The January barometer goes back to really the 1950s. And, one thing I want to mention about these types of indicators, these are what you call secondary indicators, like the sentiment readings we just went over. Those are secondary indicators. What I mean by secondary is it's just in the back of your mind. You're not going to make a buy or sell decision based on these indicators, but you're just going to be aware of the fact that there's just a lot of pessimism out there, and that's usually a pretty good time to be thinking about adding to your portfolio, not pulling money out of it. But anyway, the early warning system of the January barometers, really the first 5 trading days, which have been positive. But I will point out that if you pause your video player and look at the history here, you're going to see that there's a lot of times that the January indicator is wrong. In other words, negative Januaries but positive years. So the logic behind this is that analysts in aggregate generally update their earnings estimates for corporations in January. So if the analysts in aggregate raise estimates or improve estimates and January's up, it usually means that the year is going to be a good year. So let's hope for this year that we have a good year. Last year, if you remember, January was down quite dramatically. Now, I did want to mention a few other indexes here. This is the mid caps. These are the middle-sized companies. You're seeing here a breakout above that 200-day moving average and is in an uptrend. So the mid-cap stocks are probably the strongest sector of the market. Now, if you look at the New York Composite, which is a lot of industrial-type names, banking names, industrial names, big-cap companies that are more industrial, it too is above the 200-day moving average and actually in a pretty darn strong uptrend. So the market's changing. We'll see that in a minute here with the S&P. Now, the S&P 600, which is small cap stocks, again, above the 200-day moving average in an uptrend. So if we take a quick look at the S&P, it is approaching that 200-day moving average. It's about to kiss it, but the NASDAQ continues to have a lot of white space in here. So what you're seeing is the mid caps and the small caps and the New York Composite are breaking above the 200-day, whereas the large cap S&P and the large cap NASDAQ are not. So you need to be aware of that. Now, on the aggression index, we're seeing some definite improvement there. We're at a reading right now, 145.83. The lower moving average is at 145.87. So we're basically getting ready to break above, or could break above, the lower moving average. Now, the other aggression index, which is the NASDAQ, compared to the S&P, still got a little bit of white space in there, but is showing signs of improvement. Now, in our 3 economic indicators, I still am just really amazed that interest rates are staying this low on the 10-year Treasury. We're still hanging around at 3.5%. Oil continues to stay below the 200-day moving average and is in a downtrend. The financial stocks are definitely showing improvement here above the 200-day moving average. So that's where some of the action is. Now, on the bond market, this is our junk bond fund. You can see much improvement here. And in fact, it's actually on a buy signal going above the 200-day moving average and actually working its way up. Now, this is junk bonds, so this would be a reflection of the fact that maybe the market's discounting no recession and also discounting lower interest rates. China is perking up. They're opening up. You can see here, this is the PGJ, which is all the Chinese stocks that trade here in the U.S. You got a breakout here on fairly good volume, above average volume, and it's starting to uptrend. So the Chinese stocks are starting to look kind of good. Now, I did want to mention one of our stocks that we're going to do a little bit of fundamental analysis on, but I'm going to take a different slant on it. This is a company called United Rentals. They're involved in equipment renting, mainly, large equipment, and so forth. Now, you can see here, and I do have to disclose, we do own this stock. It broke out of this extensive base here. It broke out on pretty good volume here. It had a little bit of negative volume here, but overall, you've got positive volume going into this breakout. Now, the thing I wanted to do here is to take a look at what I call the cousins. This is Caterpillar, which again is equipment, commercial vehicles. Again, you can see the same basic pattern here where we're getting a breakout, making new highs. Caterpillar looks good and so forth. Now, we're going to look at the numbers here in a minute. And here's a local company here in Baton Rouge. In fact, I went to junior high with the president of the company, a guy named John Inquist, good friend. Anyway, you can see the same pattern here, breaking out, looking very, very positive. Then if you just take a look at John Deere, kind of the same story, not as attractive as the others, but still looking good. Now let's take a look at the numbers on United Rentals so that we can see how well is this company doing as of the most recent quarter, which was September 30th. Now they're probably going to be announcing fourth quarter results here in a couple of weeks. Profit margin, strong, 17.5%. That's good. This is a good business. Return on equity, 33%. So they're doing well there. But I will immediately jump to the fact that they've got a pretty good bit of debt on the books. But when you can generate a return on equity of almost 33% using debt to lever the balance sheet, it makes sense. The company's profitable. They got a positive cash flow. You know, their operating cash flow is positive, and even after all their debt payments, they still have levered free cash flow. So the company looks to be in pretty darn good shape. Now, they're a little short on cash here. Hard to say why. That's not really too much of a concern. I would like to see a little bit more cash on the books. However, their quarterly earnings jumped 48% last quarter. Their revenues were up almost 18%. Revenues are $11 billion. So United Rentals is a pretty solid looking situation, and the fact that all the cousins are moving up as well and doing well kind of tells you this might be some new leadership in the market. So keep an eye on United Rentals. If you have any questions, let me know. Thank you very much.